Welcome to Opto Sessions, where we interview the brightest minds from the stock market, uncovering their secrets to success. If you're looking for ideas, tips and techniques from the world's best, you're in the right place. Hi everyone, I'm Ed Gotham, and this is another episode of Opto Sessions. I'll be interviewing ex-New York hedge fund trader Patrick Reid. We'll be talking about how the king dollar influences equity prices, Patrick's swing trading techniques, and the risk management principles of Braveheart, who made $100 million trading. Hello and welcome everyone to another episode of Opto Sessions. Today we're talking to Patrick Reid. Patrick currently helps educate and mentor traders at proprietary trading house, the Adamis Principle, which he co-founded in 2016. Patrick has over 10 years trading experience, which began whilst working for one of Europe's largest prop houses. And hello, Patrick. And I just wanted to start, if you could go into detail a bit of your background and tell us about who you are, that'd be great.
Hi, Ed. Thanks very much for having me on. And I'm really excited about, just sort of telling you about my story and how I ended up as an institutional trader. And I certainly didn't start that way. I actually started majority of my career at the BBC, doing various jobs in creative. So that was my kind of journey. But I certainly I had a sort of fascination with Wall Street, the film, and I really wanted to be a trader secretly. But it was just it was a bit of a dream at the time. And I remember just thinking, I'm watching Wall Street, and I'm thinking, yeah, I really want to be like those guys. And I just think I opened up a little account with a broker, and I had some success, and I had really big days and really bad days. So I remember thinking, that was my first taste of pain and joy. And I remember thinking, God, there's something I'm doing wrong on the bad days, or there's something I'm doing really well on the good days. And I still had my job, so I was a kind of part-time retail trader. But the key thing that changed the needle, that sort of changed the needle on my career was when my friend, basically her husband was a big prop trader at Tower Trading, and we just got chatting, and I said, look, I had a bit of money, and I said, look, I fancy just seeing what it's all about. So I went over to see him. I got out at bank. I passed the Bank of England. I went to the old NatWest Tower. And, that was Tower Trading. And I went up to the third floor. I saw all of these screens and all of the kind of noise and the shouting and all that stuff. And, we went out for dinner afterwards, and basically he said, look, I'll train you. I'll teach you, And I was like, wow, that for me was my dream. It came true. So fast forward a year of absolute pain, getting up at 6, hitting those desks, getting shouted at daily, just saying, why are you trading? Why aren't you trading? What's your risk? Where's your reward? What's your ratio of R&R? What's your moving average? All this stuff. What's macro? And I just got up, picked myself up every morning after a losing day, learned from my mistakes, dug deep, and I stuck it out. The apprenticeship was about a year. So I was derivatives trade. I was trading futures, cross assets, German debt, US debt, and FX derivatives as well. And then it was only my second year I started to make some serious money, and I just felt. I remember there was the trade I did where it changed everything, and I remember I was having a poor run, and it was near December, and I was about to pack up shop or get carted out, but then it all came together, and basically that trade paid for the whole year, and I was shocked, but apparently that happens in the futures game. So the second year I did extremely well. And I just gained lots and lots of lots of knowledge and deep dive macro stuff, and I just really found my edge. And you hear about what is edge, what is how do I get an edge? Well, for me, an edge is just something you can do a little bit better than everyone else. And for me, it was data. It was interpreting US data and reading a market. I'm very good at just listening and watching and reading a market. So those two things, along with broad US macro, really helped me forge a high conviction and profitable trading setup. And then I did really well. Then I got poached. I got hand targeted by a New York hedge fund called Edgewater, and that's when I started trading spot FX. And that's when all of the knowledge I had or thought I had in that second year at Tower Trading was basically insignificant because I was then catapulted from futures, which is, let's face it, quite small, into spot FX, which is gargantuan. I was surrounded by mentors that headed up tier one banks, UBS, Goldman's, Credit Suisse, JP Morgan, and these guys and girls obviously just taught me how to listen. They taught me risk management, because essentially the bigger size you get to, the more you more you realize it's not about winning, it's about not losing, and just having attractive risk reward profiles and just listening to the market, what the market's telling you. And then, from then I just loved it. I mean, FX is my game, but I look at all assets, and you'll find a lot of currency trades, even say bigger equity traders, they all look at dollar. All the ones I do. And if you're doing any kind of size, you need to have an eye on everything. Just it depends on you can have your chosen asset, which I say it's equities. You need to know what dollar's doing. That's really, really important. And then just really speeding up to date. About 4 years ago, we opened Adamis Principle in August, and we felt that there were no education providers out there that were doing something special, that had institutional experience but could talk in a retail language. And that's where we come in. And I head up the education arm. We do consultancy and also trade for some high net worth. And one of the things I love is the teaching aspect. And because I've been in that painful retail place and I've jumped the fence into the institutional, I know how it feels for the the younger retail traders. And we're at the moment we mentor. That's the thing I head up, and that's what we continue to do. We have done masterclasses. It's tough. It's a tough gig, but we found that mentorship, because we tailor make every single person. We write a bespoke mentorship and guide to them. We found that's so much more rewarding. 20 people were mentored by me last year, by our team actually, by last year, and they've all remained with us. And in the current climate, I've never been so busy, right? So we were just talking offline before, and it's a strange, unusual place to be, but we are seeing people. Certainly, I'm sure you guys are seeing at CMC people actually reevaluating their career and thinking, well, look, I can profit from the markets going up or down, and I can do it remotely, and I can make some really good money as long as I stick to being disciplined.
And you talked briefly about your ability to read the markets being one of your sort of edges. Are you able to go into a bit more depth on that?
Yeah, of course. Yeah. So I have indicators, and they're quite simple indicators, but they're very important because they don't. I've traded every single indicator you can imagine. RSI, MACD, stochastics, market profile, Bollinger Bands, all this stuff. But simple price action and simple support and resistance is what the institutionals look at. They look at larger time frames. So that's how I was taught, really. So I wanted to explore everything, but I found that I have certain simple setups that tell me what the market's doing. So there's a very interesting thing going on at the moment, and I use time frames as confluence. So if I use daily, then if I'm looking at what the dollar's doing, for example, if I want to trade equities, I'm looking at, equities are rallying at the moment, but I'm looking at why they are rallying, and there are reasons behind that. But I think the dollar being softer is a very good reason to support that. So we basically, what we call dollar weak, risk on. That is the term that institutionals will tell you. So essentially what I look for on the daily, I look for, at the moment, if you're looking at euro dollar, it's a long-term trend lower, but short-term, which is say 4 hourly, we've broken some key resistance. So it's turning. Right, so these are the turning points I see, which really fit in with swing trading as well, and it's something that I feel I'm comfortable doing. Although I do day trade once in a while, but I feel that this turn in the dollar is real for a lot of other reasons, which will be supportive of equities. And I just feel that if you put that within the context of buying equities, then it's an extra confirmation for me.
Yeah. Okay. And if we dive a bit deeper into FX and its effects on the stock market, briefly touched on the US dollar, just so there's probably a lot of people on listening to the podcast who probably don't know the ins and outs on how US dollar impacts equities. If we could, in a simple way, sort of describe it, how does sort of King US dollar impact stocks?
Yeah, sure, absolutely. Well, the classic is a counterweight, because basically you've got the reserve currency. So in a very simple term, the dollar is the world's funding currency. It's above the Japanese yen, which is a great funder in itself. But the dollar, because it's a reserve, what that means is every country in the world needs to have a certain amount of dollars that it can draw on to pay for stuff, right? So usually if the dollar goes higher, that means it's more expensive to pay for the debt in dollar, for example. So when things are more expensive in dollars, you tighten your belt as a country, right? So you tighten your belt as an investor. So when the dollar goes up, all of the risk assets you have, you sell, because you don't want to be caught short, because it's more expensive. Things are more expensive. So therefore, stocks or equities are one of the biggest risk assets you can own, along with emerging market currencies. But let's just take the S&P or the Dow Jones. When all things are good, they go higher because people want to buy that risk. Because you're getting dividends, you're getting that increase in the value of that stock or share. Great. But when the dollar goes higher, the opposite happens, and that's in a really simple way.
Okay, so in the current climate, we're seeing, because of US government sort of let open the floodgates of $2 trillion economic rescue package, which is going to devalue US dollar. That would be positive for stocks. Is that
absolutely? Now, I've been looking like a hawk at these moves, because essentially a couple of weeks ago, the Fed bought $500 billion worth of assets in MBS and treasuries. Dollar didn't really do much in relative terms. Risk didn't do much in relative terms. Now, if you think about the other QEs we've gone through, between 40 and 60 billion a month was a good, healthy purchase of bonds. And that affected it. It gave a great lift on equities, and it hit the dollar too. Now, with so much more, like a complete wall of stimulus, the move was subdued. So that's something I take note of. So that tells me two things. One, at the time, did the market believe the Fed? No. Or did the market come around slowly into the Fed's thinking? Probably. And now that price is slowly but surely being bled in to stocks. So I think there is another reason. There is a lot of desk talk behind the scenes, talking to basically looking at a relaxation of the coronavirus restrictions. China had 0 deaths in a day. So this is probably really fueling this rally at the moment. But yes, absolutely, the stimulus really helps. But I was just initially quite shocked at the subdued reaction in the beginning.
Okay. So you think it's one to watch then? There could be, are you saying that the reaction to this stimulus package may not be as straightforward as stocks are going to hit sort of all-time highs?
Definitely.
Yep.
And some are actually calling this is a bear market squeeze. So it's and often, when we are in a bear market in equities, right? So some are saying, look, you know what? This is just a brutal squeeze, and this is all perfectly healthy and natural for a bear market. We had a 2% rally in the last couple of days on the Dow. These healthy rallies, so healthy in inverted commas, these healthy rallies doesn't mean we're buying the dips. It doesn't mean we're bullish. This is a brutal squeeze that could very well get sold into if the data supports it. And, by all accounts, it is after non-farm payroll.
And are you monitoring in order to help, if someone was interested in sort of equities, how could they sort of actively use the US dollar now to give them sort of insight into the direction that, the foreseeable future of the markets? Sure. Are you using the US dollar index to do that and things like this?
Yes and no. I'm not married to the Dixie. It essentially, dollar index is euro dollar, right? Yeah. So it's got that and a bit of dollar yen, right, and a tiny bit of cable. But the cable's sterling dollar, by the way. So essentially, I look at dollar index. A lot of the US guys, a lot of the US shops look at dollar index. I like it, but you just have to realize what it is. So just remember, essentially, it is euro dollar. Right. So if the euro aspect of dollar index is the mover, then dollar index has to be taken with a pinch of salt, because that's not actual real dollar strength. So you might get like the macro picture you might get, Lagarde cutting back on QE, which will lift euro dollar. So you'll see dollar index and you'll be like, oh yeah, dollar's great, blah, blah, blah. We're going to be buying into loads of dollars, but you could get a lot of pain from that, because that's actually not the dollar being strong. It's the euro, so it's a different kind of thing.
Okay. And so what's a better thing to watch then? If that's,
I would look at dollar EM.
Okay.
So if you want a real gauge on risk and dollar, look at emerging markets. You'll find some of the best traders in the world are emerging markets traders, just because of the stuff they have to, the stuff they have to know. You've got very volatile, very, very brutal spreads. You've got, sometimes less salubrious central banks, governments, restrictive governments, and they will clamp down on certain speculators. So when there's a broad, so look at dollar EM, look at dollar rand, look at dollar tri, look at dollar mex, look at dollar ruble, and if all of those dollars are going lower, then look at G10. Look at dollar yen, look at euro dollar, look at dollar CAD, Aussie, Kiwi, and if all of those dollars are softer, it's a real move, and then you can be buying your risk in. You buy your equities off that.
Yep. And outside of the dollar, is there other ways equity traders could use forex markets as like indicators of, or to help them trade more successfully?
Yeah, absolutely. I mean, there are some pretty decent correlations. Dollar yen to me is a great tool for equities. So dollar yen for me tracks a positive correlation with the Dow Jones cash and also S&P futures. Use this with another asset, say 10-year yield in the US, then you've got something quite potent. There was a lead lag intraday move between all of these three. And the funny thing about dollar yen is what we say to our students is to say, look, dollar yen's made up of three components. There's the dollar, there's equities, and there's 10-year yields. And if you really want to squeeze another one in, it's the yen, because the yen doesn't move at all, and that's because the Japanese government, the BOJ, hasn't really changed their policy of ultra accommodation.
Okay, that's really interesting, and it's definitely related. And I'm not sure how much insight you can give on this, but crude oil also seems to be something that people use as an indicator for equities as well. And obviously, it's been moving a lot at the moment. Is there anything you think people can use there, or is it not useful?
Yeah, be really careful on oil and gold, right? So let's just take oil, right? So oil, they say it's a great correlation with the dollar. You know, oil goes up, dollar goes lower. Well, oil's so complicated, and basically you're either in the know or you're not, right? So you've got that to deal with. I'm not saying, I'm not accusing anyone of anything, but I know quite a lot of big oil traders, and this is what they tell me. So I don't particularly want to be fighting against people who know things about supply and demand in oil. And obviously you're at the whim of OPEC. Shale is important, obviously, but OPEC's really, and when you talk about OPEC, you talk about Saudi, right? So unless you know what they're going to do, they could, MBS could come out with a big statement like it did, and no one really knew about that. So, the Trump tweets will affect oil, obviously, but they can't be as reliable as an actual OPEC country that's closely affiliated or has the power, say, a Saudi. Yeah, so you've just got it. The correlations with oil also, in addition to the supply and demand shock, which we're currently in, the correlations with oil are not that reliable, even with CAD. So there's that. There's the supply and demand. There's the heightened risk between OPEC and the news. There's a lot of behind the scenes deal making going on. There's all of that, and then you try and essentially when you're in a risk on situation, sometimes oil goes higher because everyone's thinking, okay, prices are going to go higher. But sometimes if there's a war going on or there's turmoil, then it will go lower. Yeah, so you've got all of this stuff. And then you've got to pull the trigger on an equity trade. It's just too complex and too, I probably want to double my clip size on a less risky asset myself.
Okay, sure. So that's a good insight. Is that dollar yen basically is the one to watch for those that are interested in equity markets and helping to guide their thinking. Cool. Actually, briefly touched on gold as well. Is that something some people use as well, or is it?
If there's anything worse than oil, then it's gold as a correlation. Okay. So just sort of rewind a few weeks when we had this dollar funding problem. I call it the dollar wrecking ball. It absolutely smashed emerging markets. It smashed equities. But what it did do, it smashed a strategy called risk parity. Now, risk parity is basically a model that was started by Dalio and Bridgewater. Bridgewater is the biggest hedge fund in the world. They control about 160 billion. They've done very, very well over the years, over the decades. But risk parity, in their simple terms, is when equities go lower, you buy bonds, right, as a counter, as a hedge, as a risk. As a safety haven, right? but you don't just buy bonds, you lever up the bonds. So you actually make a lot of money that way, and it has worked. But when you get the odd occasion of a dollar funding squeeze, both bonds and equities go lower. So this turned over a lot of smaller risk parity shops. And I know Bridgewater got absolutely hammered. You can see their reports. I mean, they got, a few other quant shops got hammered as well. But so gold is one of these things that got sold into the dollar funding squeeze. And, as a safe haven, great, but not so great, really, if you really boil down to it. Sometimes, this is the other thing that I learned as an institutional trader. Sometimes correlations are circumstantial. So as a retail trader, I used to get like an overlay of one chart, put it onto another chart. And if they kind of matched or diverged in equal measures, they were connected, right? Wrong. It was just a circumstance. So this is the key. And gold, along with bonds, got sold off. Now, there was talk, the BIS, which is the central bank of banks, they were selling gold, but who knows, right? But the fact is, because of VAR models getting hit, gold got sold as well. So it was not a safe haven. People say it is the true safe haven along with Swiss franc, but it wasn't. I mean, you try buying gold in the current route. In the when the dollar funding squeeze was giving rampage, then you would have been in a lot of pain. So yeah, it's unreliable, and that's the bottom line on gold for me.
Okay, great. Good one to know as well. Going to dive into a bit more about your sort of trading experience now. In particular, a lot of people are interested in the sort of swing trading aspect. To start with, I just wanted to ask, how do you mentally prepare yourself before a trading day? Is there any sort of routines you do or anything to help?
Yeah, I was going to say I meditate and do yoga and do all that stuff that you see on LinkedIn and all these like social media platforms. But I don't. I'm not that good. I'm a bit more practical. So I wake up around 6, just because I've been doing it most of my life, and I wake up around 6. I look at Asia. I look at what the previous session is. So if you wake up in Asia, you look at North America. I wake up in London, so I look at Asia. What happened? Just ask yourself, okay, were there any big moves? So it all starts from the moves. I look at equities. Have they moved? I look at which equities, which indices have moved, and then I try and find out why. So I look at the macro, I look at any announcements, and then I base my current market view on that, and I use long-term versus short-term. So I use what we talked about before. I use the daily and look for a turn in the market if that is happening or not. Then I create my market view in dollar terms and in risk terms. And in risk terms, that means equities and emerging markets and 10-year yields. So I then have my view. I've laid out my stool. I look at the events, the risk events in the day and in the week. I take a step back and go, look, this is my view. Yeah. And then I look for levels where I'm buying or selling. I look at my risk management, decide the clip size, my risk reward, my stop. So where am I wrong? I look that within the context of my broad risk management. How am I doing this month? How am I doing this 3 months? How am I doing in the 6 months, in the year? My P&L, my yield return year on year. Then I pull the trigger.
And you touched on there, you talked about emerging markets, 10-year yields. Yeah. Are you talking about FX? Are you talking about or the indices?
No, I'm talking about the currencies in emerging markets and the 10-year yields on the US Treasury. So the T-notes.
How do they help with your sort of analysis of what's happening in the markets?
Yeah, so it's a risk play. Is it risk on or is it risk off? So usually when dollar's going lower in emerging markets, then it's risk on. So
Equities.
that means I'm bearish dollar, but I'm bullish risk.
Okay.
So bullish equities, basically, in GSM.
And is this because you're looking for the big institutions and where they're putting their money, and they'll base it on the dollar, like, and its weakness?
Yeah, yes and no. I mean, I get word because a lot of my friends still work in the bigger hedge funds and banks, but I don't. I'd throw caution to that because I don't follow flows, institutional flows, and you should just really not rely on that. You might hear of an M&A takeover and cable will be rallying, blah blah blah. But for me, everything you need is in the charts. So if you look at the way the chart is telling you, if you look at like the dollar, right, and you're like, okay, what is the dollar doing against certain currencies? How well is it doing it? What is it trying to do and failing to do? And you just have to sit back and listen and let the chart come to you. Enjoy it, because very good ex-Goldman's trader told me the price is always trying to tell you something. All you have to do is listen.
Yep. And so this sort of like segues into sort of time frames, and are you using candlestick charts, I assume, and are you looking at what are you looking at time frame wise for day trading to get the sort of more macro overview and then diving into the trading sort of view?
Yeah, I think the bottom line is you've got to be flexible, because you have to sometimes intraday to get bags and pips. You have to look a bit more long term if you've got like a solid macro view, more long term. But I do a bit of both actually. If I see an opportunity, I'll take it. And I'll have an idea. If I'm going for like a 2 to 3 week duration, then I'll have it's got to be a very firm macro view. And obviously at the moment, especially last year, macro's been all over the place. Last year, Fed cut 3 times and dollar went up, right? So, I mean, that doesn't make sense. So, you've got to really bear that in mind. But yeah, I mean, I use daily charts and I use 4-hourly charts for an entry. I used to use hourly when I traded data as a futures trader, but now it's too noisy, far too noisy. And obviously with vol, very, very, very high, you get stopped out. So I just stick to 4-hourly charts for my entry, and my market view is on daily, sometimes weekly, just to get a bigger picture. But yeah, daily's my go-to.
And in terms of holding periods, you're looking at sort of 2 to 3 weeks to see the returns generally at that sort of time frame?
Yes and no. I like to go long a currency if I'm feeling, or sometimes equity, if I'm feeling like everything's going good. This will need, like the proverbial oil tanker. This will need a lot to turn it around. So there are certain things I'm pretty strong in believing. At the moment, I guess I'm 75 or 80% there on a lower dollar, just because of the stimulus.
Yep.
Because of the rebound in sentiment and the rallying stocks and the emerging market scenario with the dollar. But yeah, that would be a 2 to week window.
So they're all indicators of a lower dollar as well. They work.
Yes.
They work. Okay.
Yeah, absolutely.
So it works. You can also get indications from equities and other things of a lower dollar as well.
Yeah, totally. Yeah.
Okay.
And sorry, go on.
No, please continue.
Yeah, so intraday, I would. Yeah, sometimes I'll buy and sell within that core long or short position. So if I've got like a resolute macro view of, say, like I have a lower dollar, I would then add and take away some of those dollars within certain pairs.
Yeah.
So I'd be like intraday, like 4 hourly, I'd be like, yeah, okay, I'm long euro dollar 108.50s, right? I'm knocking them out around 110s. I'm rebuying those with a core. I'm rebuying those halves 30 pips lower, selling them out 50 higher. So you're doing that, but you're keeping this long position, but you're just taking advantage of buying and selling within that long position.
Okay. And in terms of it's probably more complex than this, but what's your simple approach to taking profits or closing out winners? When do you are you always like setting a level before you go in?
Yeah.
Are you coming out like in thirds during it? There's a lot of different ways, I suppose, you could approach it.
Yeah. Look, I've done everything, right? I used to be, and talk about entry level as well. It's in stops and all that stuff. You've got to be really flexible and do what works for you. But the rule that I always have is have multiple targets and change your targets if the facts change. So put your squawk on, right? Just listen to what's going on in the market, because you could be 90 pips on side, right? And then and your first target's 100 pips. And then some central banker can come out with Trump tweets something that could erase 70 of those pips, because you're fixed in your stop. You say, no, I'm not going to do it. I'm going to wait. I'm going to be, this is my plan. This is what I'm going to do. Actually, you're the loser. So usually I would take profit all the way up to that 90 pip, and generally, depending on my risk reward ratio, for example, if you have a stop at 20 pips, you probably want to start to nibble your profits as it takes some profit around 40, 50 pips on side. So, at least have a 2-to-1 R&R. But then obviously when it becomes 50, 60 pips on side, you take a little bit more off, and then you move your stop up. It's just a kind of, this whole kind of trade management is an art. I mean, you've got anyone that says you only trade a 4-to-1 is frankly living on planet Mars, because you have to be flexible. Otherwise, you're just not going to make money.
And do you ever add to winning positions? Sort of double down on them?
Sometimes. When the facts change, I do, but I tend to have a, if I'm adding to a position, it will definitely be less than my original clip size.
Yeah.
So it usually be the ratio of 3-to-1. And the final adding of my position would be like a third of the 3.
Yeah.
So if I start with a 3 lot or 300,000 CFD, I would then, 40 pips on side, I'd add another 2, and then I'd add another 1 after that.
Okay. And in terms of risk management, what's your sort of general approach to that? You mentioned risk reward ratios, etc.
Yeah, I mean, the thing about risk management is at any one point, and you've got to know what you're about to lose. And we teach risk management at Adamis Principle. And rule number 1, fact number 1, risk management is not about being defensive. It's about being aggressive and defensive, but knowing when to do that. And it's about defining risk. It's about owning it, being the captain of your risk, right? At any one point, there's a big trader called Braveheart at Tower, right? He made 100 mil, right? But at any one point, he could have told you what percent per trade he's into, how many losers, how many winners, what the win-loss ratio is, because he recorded all of his trades. Yeah, he smashed it, of course, but at any point he knows what he's going to lose. So that's the key to it. It's knowing where your stop is, how much your clip size should be, looking at the risk in the volatility of the currency or asset you're trading, knowing the liquidity risk, knowing the event risk. All of this stuff you just need to know. You don't need to be perfect, but you need to be aware of it. So, having an open position on oil over the weekend is not recommended. You'd be surprised they'll have people that do that, you know.
Yeah.
Currencies are obviously 24/5, so that's a bit kinder. Equities are fine if you know what you're going to lose, you know, and factor in a bit of slippage. So, you know, if you're buying, you know, S&P and you've got a positive stop, then you're probably going to be okay, you know. So even if it gaps lower in Asia and Sunday night, you know, in S&P futures, you're probably going to be okay with that. But at the end of the day, you know, and also if you're averaging, you want to be writing out all of those separate average trades to find out the total of what you're about to lose. You know, how many days have you got in you? How many trades have you got in you? Out of your capital, what is your limit? Is it 20%? And then you walk. You know, I say this to my young traders, you know, I've seen people get carted out on futures desk, and they're you know, it's not pretty. So, you know, if you can walk away with 80% of your capital, you know, you're doing fine. You can always come back. You can always come back. Don't be scared of losing. It's not embarrassing to lose, you know. So just really, risk management is like, probably, as you trade bigger size, it's probably the only thing you need to know, really.
And what would be sort of the minimum risk reward ratio you'd just for any trade? Is there something that you have as like a rule for that?
Yeah, I like my sweet spot's 3-1.
Okay.
But I'm okay with taking a bit of profit at 2-1, and then you've got a free trade, right? So
yep,
that's it. And you know what? Getting a free trade means you've got maximum upside and no downside, which to me is the best risk reward.
And would you ever, instead of taking profit, move your stop instead to maintain full size? Yeah.
Yeah, and that's where your arbitrary skills come in. That's how you massage it. You take good care of it, because if you do that in such a way that you know you live and breathe your currency, your chosen currency, or your asset, and you're like, yeah, I know this, I've got this, because you've done it time and time again, and you're thinking, okay, today volleys are higher, so what's my ATR? So I'm thinking, okay, I'm not really going to be moving my stop too quickly. Now, one of the things most traders lose money on, in my experience, retail traders, that is they move their stop to scratch on entry far too quickly. So they
don't give it any breathing room.
They just don't give it any time at all, or they never move their stop and they never take profit. So it's just a balance, right? So it's a case of, you know, you can't lose money if you take profit. That's the old adage. Okay, so great. But what I found is a lot of win-loss ratios are around 50-50. Many of my good friends who are traders have a 40% win rate, right? They're the best traders in the world because they have great risk rewards. They stay in their trade for pretty much ever. And you're waiting for the big move, right?
Yeah.
That's the move that's going to make you positive in your yield year on year. It's not the ins and the outs. It's that 3 or 4 big figure move. You know, those are the things that you really want to capture. And by reducing your stop in a prudent way, will enable you to do this.
Okay. And obviously, at the moment, the markets are extremely volatile. It seems like actually it's been volatile for a while. Periods of time it does get extremely volatile. How is it best to sort of deal with these sort of volatile environments, to not put too much risk on the table when things can get, you know, move extremely quickly? How can you still trade like in these environments with some accuracy?
Yeah, absolutely. So, like, as a trader, you like if when you pull the trigger, right? If you're sweating, if you're feeling uncomfortable, you're doing too much size, right? So you need to be very comfortable and convicted and have high conviction in your trade. So it's the same with vol. When vol's higher, you reduce your clip size and you increase your stop, right? So in high vol scenarios, often, not always, but often there are less participants. So you get thin liquidity. And what that means is you get extreme moves. So less amount of clips do more in the move, right? So essentially, yeah, you get your big flows here and there, but essentially, because it's quicker, there's less people doing stuff, right? So that's often the case with high vol. Essentially, what you'll find is in that situation, just relax. It's okay. You can still make the same amount of money on a slow moving wildebeest like Eurodollar, which is kind of not a straight line, or fast moving gazelle like dollar rand, right? You just have to keep your risk in check. So you reduce your clip size based on the riskier scenario, and then you're okay. It's and that's how you trade vol, really.
And did you mention ATR? Is that average true range?
Yes.
ATR? And how you use that as a guide for volatility? Do you or?
Yeah, I mean it's a near-term guide for realized vol. So essentially, each currency pair has an ATR attached to it, and I like to use the 20 or 22, which is essentially the average range of that currency pair or equity. So essentially per day, and you can slice and dice it any way you want, but essentially it gives you an idea of the ranges. So it's the average kind of trade range of that chosen asset, and you use that to not determine, but give more indications of your appetite for the risk and your reward. So and also if your chosen asset is falling below the average ATR, then that's fine, but expect it to have a spike above it. There's different ways to play that. If the market is above and beyond the ATR, the average ATR, say Eurodollar, I think was around 90 last time I looked. Then
that's the amount of pips it's moving in a day, is it?
Yeah, pretty much. Yeah,
on average.
So Eurodollar, if Eurodollar is moving around 80, 90, for example, it might be more. I haven't used it for a while, but that's you use that to say, look, if the market's already moved that amount, on average, it won't move more than that range in that day.
Mm-hmm.
And also, if your target is 200 pips away, then you may not get filled.
Yep, that makes sense. And lastly, I've got one last one for the trading experience sort of questions. How do you handle situations where you may have had a few losing trades in the row, and you're sort of rocked a bit mentally? How do you get sort of back in the game?
I went to the loo and had a little cry in tower trading. And then I came back and I just picked myself up and told myself, it's just a trade. Yeah. So nothing prepares you for a string of losses. I mean, I've had 10 losses. I've had 10 ropey days in consecutive order, and nothing really, and I was doing some proper size back then, and nothing really prepares you for that. Your guts churn. You feel like you feel like peanuts. You feel like nothing. But it takes a good mentor to bring you round to say, look, this is normal. This is absolutely normal. How much have you lost within your capital? Each trade is 50%. It's one of 1,000 trades. You're good. You dig deeper. If you made a mistake, sit back. If you're breaching your monthly risk, take some time off. Go for a run. Have a massage. Take a weekend off. Go away for the weekend. I mean, obviously we can't do that now, but just take the dog for a walk. Whatever it is, just don't trade. Don't say, look, I'll look at the screens and not trade, because as a trader, you'll find that very difficult if you're like me.
Yep.
So just bear in mind you're in good company when you lose, because many very good traders lose. The mark of a person is to learn from the experience of loss, to pick yourself up. It's good to have a good mentor as well, but to pick yourself up and realize that this is all part and parcel of trading,
Yeah. It's a good time to mention that, because we're going to go into the part where we want to discuss a bit more about mentoring. And, obviously at Adamis Principle, that's you mentor a lot of individuals into becoming successful traders. What sort of personality traits do you commonly see in successful traders, or are there any?
I see all kinds. I mean, we mentor at all levels. We mentor. We have some institutional clients from banks who want to they're off their mark. They want to get back on point. We've got savvy retailers, like pretty big retail traders too. So I would just say usually the common appetite of risk is the thing that I see as a success. But the key failure is not harnessing that, not reining it in when it's needed. I think being resilient is one of the things. I mean, risk management's important, but all of that, all of the macro, all of the technical analysis, all of the market reading can be taught. But risk management, it just requires a lot of discipline and swallowing your pride as well. You've got to be very humble. A month ago, I got humbled. I took a bit of risk on, and I got humbled. And very quickly, I have a mentor, right? I have a number of mentors, and they're big traders. I called them up. I said, I've just really done myself in today. And they just went through the same process we go through as mentors. Just look at the facts, look at what you've done, why you got the pain. Pick yourself up. You're not defined by your trades. It's just a job. I mean, people live and breathe it, and I expect good traders will use that as a passion, but I just feel you've got to take a step back and just realize that. But coming back to your question, I feel appetite for risk is important. You've got to know, you've got to have a go, but also risk management, being tight and aggressive, knowing when to rein it in, but then, smash it. But I think for me also is resilience, because when you're trading and you're successful, you're going to be feeling a brand new kind of pain and joy in your life that you can't actually explain to someone who's not a trader. You can't, if you have a different career, you can't explain it until you actually live and breathe it.
Yep. And how important is mentoring for traders?
Well, I think it's essential. I mean, I'm on the phone to my mentor pretty much every other day. And we do provide that obviously at Adamis Principle. And we found that just checking in your thinking, checking in the moves and not always agreeing, but just sense checking your own views and going, have you heard what's going on? What are the institutionals doing? How's the market reacting in your view? And just getting that confirmation, and also saying, look, I'm having a bad run. What am I doing? Because when you're in the midst of it, when you're at the coalface, it's very difficult sometimes to actually realize you could be making a very, very simple mistake and you're not aware of it. But it's just someone to guide you, someone to give you their experience. The team I head up has over 30 years experience in tier one banks and hedge funds. So, I'm buy side, I'm prop myself, but we also work with a lot of sell side tier one spot FX traders. And they've seen, from 85, 87, 98, 2008, 2002, they've seen all kinds of crises. So and they've survived. And I've seen a fair few big moves on the markets myself. So it's just to give them a holding hand to say it's going to be okay. This is what you're doing wrong. This is what you should be doing a little bit more of. Here's the bit of guidance and tuition.
Yeah. And so experienced profitable traders also benefit a lot from mentoring. Then it's not just for beginners.
Absolutely. And you know what? The day I come up to you, Ed, and say, look, I've cracked it, then I get my coat. I'm done, because that's when I'm in big trouble. I mean, I speak to some very big traders every week. They're humble. They're the most humble people you can imagine, right? Because the markets are like the weather. They are like the sea. You never know. You could have be the biggest boat, the biggest cruise line, you still get sunk. So the weather it's unpredictable. But your job as a trader with proper risk management and guidance and mentorship is to say, look, let's look at the forecast of the weather. Let's get the proper boat for that. Where am I traveling to? What is my crew? What's my crew look like? And what are my provisions? For that journey. And that's all part of mentorship.
Yeah. Oh, thanks, Patrick. Lastly, I just wanted to there's some quick fire questions. Just wanted to go through very quickly, and not meant to take too long to sort of like go through them, but whatever comes to mind, just to finish off the interview. So the first one is top 3 mistakes traders make.
Fat finger, too big a size, and trying to be a hero.
Could you just the fat finger? Can you go into a bit more detail on that, just for people who might not know?
Yeah, sorry. Fat finger is when you pull a trigger when you make a trade and you're not supposed to.
Yeah, okay.
Basically. So it's not coming out of that and just like go, oh, I made a mistake. Sorry.
Yep. Okay, and where or who do you go to for market insights?
I go to Bloomberg, Reuters. I have we have partnerships with a lot of tier 1 macro agencies. I call my mentors, but I also look at CMC. Actually, bit of a plug for yourselves, but I do look at market pricing on equities. They're a great source with CMC, and also, I try and look at everything. There's another website I quite like called Forex Live. I look at that as well. But on the tweets as well. I mean, Trump is a gift that keeps giving. I'm across his. Zero Hedge is another good website. So all of these together, but obviously don't look. Just be flexible and scout around. I have Squawk as well. So Squawk's good.
And what's Squawk? Sorry.
Squawk is basically a radio station with institutional experience, they're plugged into all of the wires, and they basically blurt out or squawk out what's going on, what the figures are coming out. So round Squawk, live Squawk, OTC, these are ITC, in touch markets. So these are the Squawk, the major Squawk companies that really you have in every trading floor. So they're like they give you market commentary throughout the day. Okay,
great. Just keep you on top of the market, basically.
Yeah, exactly.
Everything's coming out.
Yeah.
Top tip for your younger self?
Stay on the demo for longer.
Really? So that's interesting. Like some people, there's always people are. Is it Trevor recently said he wasn't a massive fan of demo. Other people think demo's good. You think demo's a good one to get your sort of basic strategies and stuff in place?
Yeah, I mean, I think what I'm not going to paraphrase Trevor, but because I wouldn't dare to. He knows far too much than I do. But I think what he was saying is demos are different to real, which is true because it's a demo, right?
There's no pain. Is there?
Well, there isn't. But what we do at the Adamis Principle is we seamlessly transfer you from smaller size to bigger size, and that follows the exact same process of deciding when and when not to trade. So the same applies to a demo to real. And when I was at Tower Trading, and a lot of institutional traders find a lot of value with the demo.
Yeah.
it's sense checking your strategy without losing any money. I mean, what I will say is it's been given a dirty word, but it's not. I mean, I'm not saying go on the demo for 6 months or a year, but do it long enough so you feel comfortable enough to then make the transition to a real account when you're ready, because essentially when you do hit real money, your job is to stay in the game for a long time. If you're making schoolboy errors, then you would rather make that on the demo, right? So when you do hit the real account, you're going to stay with that broker for a long time. You're going to be profitable. You're going to have a positive equity curve, and you're going to make mistakes, obviously, but you'd avoid all the really glaringly obvious ones in the demo, hopefully. And then when you do hit the real, you make some nice money.
Yep, of course. What's your favorite charting software?
I particularly like TraderMade. So these charts, and I post a lot on LinkedIn. So these charts I post, we have a partnership with them, and they're brilliant. They have a partnership with BNP Paribas. They started in 1985, and they focus on currencies, but they also do Dow Jones and S&P. The reason I like them is they're really clear cut. They're very sharp, and you could have a certain sentence. There's no clutter. They're very, very clear and clean. And I like it simple, and I like it clear and clean and crisp.
Next question is Bitcoin, yes or no?
Definitely not.
Definitely not. Same as gold for you.
Yeah.
Yep. So, and lastly, I just want to, stock market prediction I put down is maybe sort of like near term, next 6 months. Are we seeing, from what you're seeing in the dollar, you obviously you've mentioned you think there's going to be a weaker dollar. Does that mean potentially you're thinking a higher stock market, or
I
it's obviously
think
more
so.
complex than that?
It is a bit, only because we need to get a cure for coronavirus, right? So we're having buying this kind of rumor, this goodwill rumor, but the only thing I will say is we're going to be capping a lot of we're not going to enter new highs in equities. That's just my view, obviously, just because the stimulus we've had is not going to be like GFC stimulus. The money from central bank rhetoric is wanting it to go to Main Street, not Wall Street. So buybacks and divvies are being capped. It's for those reasons I see a natural cap to the highs we've had, which were quite bubbly. But yeah, I mean, a weaker dollar does support stocks. So near term, I see stocks higher.
Yeah. Brilliant. That was the last question. I just want to thank you again, Patrick, for the interview. It's been really insightful. I'm sure our listeners are going to learn a lot from it. If there's an ending note you want to leave with, where they can people can find out more and talk to you, or if they want to join or potentially talk to you about Adamis Principle, where do they go?
Thanks very much, Ed. It's a real pleasure to be on the show, and you can contact us. I blog avidly on LinkedIn. So if you Google, if you look on LinkedIn, it's Patrick Reid, Adamis Principle. So I'm an avid blogger. I have about 6,000 followers. But look at our website, adamisprinciple.com. There's another way, and you can find my email on there. Or connect with me on LinkedIn. That's a good way. And if you have any mentorship requirements, our team will be in touch. Happy to help.
Perfect. Thanks very much, Patrick.
Great. One final thing, Ed, if that's okay.
Yeah, of course.
We actually seed people, traders, our mentors, mentees, into various shops. So we do back people after they complete our mentorship, our 6-month mentorship. So if you're thinking of perhaps not wanting to provide capital for yourself, we will certainly help you with that if you do our course, our mentorship course. Yeah,
it's great to hear. That's good to see. There's still some really good business around doing that. Perfect. Yeah, that's it, Patrick.
Thanks so much, Ed.
Thanks for listening, everyone. Just a quick note before we sign off. If you're looking for an easily digestible daily update on the markets, this might be of interest to you. Opto Updates is our short newsletter sent every day during a trading week, giving you a bulleted list of the top 7 stories from the global stock markets. We've done the hard work for you, highlighting relevant opportunities and trends, and in addition, we'll also keep you notified of any new podcasts, stock reports, or events from the Opto world. If you're interested, sign up using the link in the show notes. Until next time.